Welcome to the last section, which will cover the trading by itself, and this is going to be about the auction market theory, about the market profiles, and about the volume profiles. Um, like I said in the previous part, using a price action and the order flow can be often enough, and I think the auction market theory um, changed a little bit throughout the years. Obviously, it's as you can see. Although I will cover, I think, all the things in those videos towards more of the details. From my personal trading, you will see that there are only a handful of things what I consider to be really important, where markets will can provide us with some sort of a reliable levels for reactions as well. So, what is the auction market theory? The auction market theory basically breaks down the market's primary purpose and how participants interact to fulfill it. The This purpose is basically a facilitating trade in the two-sided auction and seeking a value. This whole concept was created by Peter Steidelmeier back in the 70s, who is also creator of a market profile. Um, and he what he basically did, he plotted this kind of a bell curve distribution and uh, said that most trading is always happening within the 60% of from the fair value, from basically the middle, which is the value area for the profiles. So uh, this is the kind of a theory how markets are moving, and I already talked about it previously. You have these efficient markets, which are markets that are in balance. Then you have this supply and demand kind of imbalance, where either demand exceeds the supply or supply exceeds the demand, which creates the inefficiency, and markets then are on a way to seek a balance. Okay, so this is this kind of a circle that keeps happening in the markets. Um, the main components of the auction market theory are the price, which advertises the opportunity, time, that is regulating the price opportunity, and the volume, which measures the success or failure of the auction. Volume measures the interaction of market participant and different levels. So all these things play a kind of importance. If we should translate this into more of a simpler terms, obviously the price is kind of a where you get your trading levels and trade ideas from. By looking at volume, this is your order flow basically, where you are looking the interaction at the levels, and at the time also plays the key factor, because especially if you are day trading or focusing on any sort of a shorter term trades, you need to execute your trades at the right time, because most of these markets have a windows of volatility, and once that is gone, you are just stuck in a position. Okay, so these are the three main components of auction market theory. Another kind of components are obviously the balance and imbalance. This is something that I mentioned back in when we were talking about the market environments. This is just another term for trends and ranges. Okay, the balance is where buyers and sellers agree on prices and they are willing to trade at them. So market is stuck in some sort of range, and it will just mean reverting towards any sort of mean you have plotted. Lower volatility due to the higher liquidity and medium lower volumes. The fair value represents 68% within the Gaussian bell curve, which was the thing we saw at the beginning. The imbalance is disagreement in a fair value, and one side is more aggressive and it's initiating the activity. Market is in imbalance until it finds the new fair value. Okay, the responsive and initiative activity is that responsive activity is expected. When markets break below value, the buying is expected. When markets break above the value, selling is expected. Mean reverting behavior in the markets. So what this means is that when you have this fair value where the market is obviously trading inside it, you are in a range basically until proven otherwise. Okay, so if this is your fair value, markets are expected to revert back inside the mean until the range is broken. Okay, so this is your responsive activity, which is often expected, and this is the initiative activity, which is not expected. When markets break below the value, selling is unexpected, and when markets break above the value, buying is unexpected. Shifts in momentum only occur when whole environment shifts. Trending behavior of the markets. Markets are usually in range rather than in trend. Okay, so the initiative activity is this kind of a thing which is not expected when markets are trading in the range. We can see it here basically. This is the E-mini S&P, and you can see how this market is, trading inside this kind of a fair value. Every time it exceeds outside, it's going to revert back to the mean. Once new information comes out, it's going to sell off. Then it's going to bounce from the value for a day, sells off again, and then it's kind of a still sitting. It's more of a bouncing from the values until any sort of new information comes into the market. That's not when it comes to these things, and when it comes to whole auction market theory, it's a theory. It's a how markets are ideally expected to work and behave, but the price action and order flow will dictate these behaviors. This is just something you are supposed to be expecting, but you will need to have a actionable trading setups for everything you do. So like I said, it's a theory. The acceptance and failed auction is obviously the acceptance happens when buyers and sellers agree on prices inside the value. Once market breaks the value on conviction, on convincing price action and volume, we look at acceptance outside of the value. That tells us that market participants agree on new prices. The failed auction happens when market breaks the value but does not gain acceptance. Increase in volume in breakout often leads to failed swing and mean reverting behavior. Okay, so we have it as an example here. Market forms the value, trading inside it. You have pick up in volume above here. It failed to gain acceptance. It will then flush quickly lower and gains acceptance below the value. This is often seen in a time. The time is a good measure for acceptance. The longer the time market spends outside of the level, the more likely is to accept. This is why for example, when you have some sort of a cluster or the value and market breaks from it, I'm not I'm not basically just sticking the limit order here after the first kind of a candle, because what very often happens is this. Okay, you want to see market breaking outside of the value and then this gaining some sort of acceptance to see that really the buyers want to hold this market above the cluster or the value, and only then you can just stick your limit order here and play the continuation. As you can see, we break outside the value, we gain acceptance, market then pulls back into it, tries to accept here, makes this kind of a failed swing at these highs and continues lower, forms a new value. But once again, once we break outside of it, and form the acceptance, it acts as a resistance. What is a good thing to observe are these kind of for example, this is your reliable signal where you have this. I know it's not the cleanest example, but or you might not have been able to see it too clearly, but you have a cluster here which took out this previous high, so there is nothing, no unfinished compression above that you should be worrying about. Market breaks below and then makes this inefficient move on a high pickup of the volumes inside the cluster, which sits as this composite value area low and sells off from here. So this is your good level to trade, and we pay it one more visit and sell off from it again. Okay, so this is about the acceptance and failed auction. Here are the auction market theory rules. Okay, there are 5 of them. In all honesty, you will be basically working only with 2 of them. Or 3 of them. Let me just talk about each of them. So when markets, the rule number 1, when markets are coming into the prior value area and find a acceptance there, they are most likely to retest the value area high and travel towards the value area low. This is the rotational market inside the value. If market is already in the value area, it will bounce from the edges until it finds acceptance outside. Okay, if market finds the acceptance outside of the value, it will often retest the value area low or the value area high before the continuation. Market that swiftly move inside the value but bounce aggressively from POC is likely to continue higher. This is the idea of the clusters. These inefficient move inside these levels. Market will just strongly bounce, ignore the value area high, and just continue to the direction. If market is just kind of a consolidating at edge of the value, it's more likely to break outside of it. Okay, so these are the 5 rules of the auction market theory. Once again, it depends on your trading style, and this one is important. You will see the naked points of control are going to be important levels coming into the future. Other than that, these are more of a intraday plays. If you are not working with any sort of a composite value area. Also, what is worth to mention at this point is that these market generated levels, which value area highs, value area lows, and points of control are, can get easily kind of spiked through. That's kind of a thing with every level that is automatically generated. Okay, so what very often happens for kind of a intraday trading is that markets break outside the value. You are expecting this perfect retest of the value area low, but market will do something like this, for example, and you might have some sort of a cluster sitting inside this value area. So it's much better to go offer there rather than just simply putting your offer here, because if there is any level that is generated from the markets, it's easily to get kind of squeezed from any sort of larger traders. Okay, so let's take a look at the market profiles and volume profiles.